Let's check in on the markets activity over in Kenya. Now, recapping on trade as it played out on the markets yesterday, the Nairobi Securities Exchange had the main NSE 20 share index rising 0.4% by the close of the session, leaving the index just below the 4,733 mark yesterday. And that as the market recovered from a 2-week fall. Remember that this index initially surged 7% in 2 sessions, and that after Uhuru Kenyatta was announced the winner of the election on March the 9th, but lost all the gains as it became clear to the market that Raila Odinga was keen to challenge those very same results. Now we have the market receiving strong support from investors seeking bargains as most share prices seem to have stabilized and trading within their fair values. On the company news front, Nation Media Group again taking things higher. The region's leading media house extended gains yesterday by a further 2.8%. We had that share price ending at 330 shillings per share, and that after the company posted a 25% rise in full-year profit last week and offered a 1-for-5 bonus share in the course of the week as well. So that's certainly seeing some investors encouraged towards that stock specifically. On the currency front, the Kenyan shilling weakened in the meantime as importers bought dollars with an eye on that ruling on the challenge to the presidential election, and those results expected at the end of this week. We have the unit coming into this morning at 85.85 to the greenback, where it's been trading in a pretty tight band of 85 to 86 against the dollar since Odinga took his challenge to the courts. If the court rules in favor of Odinga and orders a fresh election, the political uncertainty that would result would likely weigh on this shilling moving forward. So that a broad sense of what's played out on the market scene. Let's get into some analysis now with Ted Macharia. He's an investment analyst at AIB Capital. Ted, thanks so much for joining us this morning. Well, it seems that we've got investors looking to take advantage of some of the opportunity. As I said a little earlier, we have many seeing the bargains that are now starting to pop up on the NSE as most share prices seem to have stabilized and trading within a fair value. What's your sense of the markets right now?
Morning, Alicia, and thank you for having me. As you've said, the optimism in the market generally outweighs the uncertainty in the political scene. We have seen investors looking for bargains, particularly in the banking and insurance sector, where valuations fell last week because of selling pressure on most counters. So most investors are bargain hunting as well as prepping themselves for dividends in those sectors.
Banking and insurance, as you say, those shares are rising in those respective spaces as a result of heightened expectations when it comes to results and the dividends that these investors are expecting to see as well. In the results scene, though, all is not a bed of roses. We've had fuel marketer today, Total Kenya, saying that it's going to be posting a financial loss for 2012 after it was forced to settle a legal claim in a London court. We've said that no detail has been forthcoming with results with regards to what exactly has played out here. What sense are you getting of Total Kenya?
Total issued a profit warning statement earlier today, saying that their earnings will fall by more than 25%, citing the case that was in London. Triton Oil was a distributor company that was given the contract to sell oil worth about 7.6 billion, but the oil did not materialize here in Kenya. So Total agreed to pay a settlement outside court. They haven't yet given us any clear direction on what that means. But the directors were quick to say that that the end year results would have been a profit if it were not for this case. So we'll still wait and see for more information.
The fact that we've had the companies say that excluding this exceptional settlement, the company would have returned to profit, does that ignite some confidence on your part? Because still we've had detail lacking, and some would assume that this would be unnerving for investors.
Yes, it is, particularly because of the uncertainty that surrounds the energy sector, particularly the oil distributors. Kenol, the whole of last year, was in talks of acquisition that fell down just earlier last month. So looking at it from a sector overview, it is not good news. It is perhaps distressing to investors that the sector has the capacity to make good profits and good earnings for their shareholders, but is involved in other on-the-side issues. So
give us some
all in
detail
all,
there,
it
Ted,
paints a
in
bad
terms of
image.
what is hampering their ability to, to bring sustainable profits to the fore.
I think key is they do not maximize efficiency on their distribution networks. Kenol, for instance, was a good candidate for Puma Energy because of its large network, but it profits usually, the margins are very thin. Obviously, you could say it's oil cartels here locally in Nairobi, or that it's a very regulated market. However, they should be doing better than the results they present every year.
Do these companies have enough of a regional focus, Ted? Because, I picked up an article on the wires this morning saying that we had profits, Kenyan firms operating in East African community subsidiaries, really, seeing their profits rising on the back of that diversified exposure to the region as a whole. Do we see these fuel marketers, managing to keep up with that pace in terms of expansion on a regional basis?
No, and that lies mostly in regulation, in that the governments in respective countries in East Africa are the ones who take great control of oil distribution. In the banking sector, for instance, Kenya leads in innovation in East Africa, from the M-Pesa platform to agency banking. And because of like-minded central banks, we're able to see products being diversified and being brought into other East African countries. But when it comes to energy sector and oil in particular, the governments take a lot of control, so it is hard for oil distributors to take a regional view of the entire process.
Do you think that governments need to take the next step in this regard, lessening the bureaucracy within that energy space specifically, and leveraging off what is the East African community?
I think the biggest hurdle is the new oil finds that we've had. Kenya has discovered new oil, so did Uganda, so did Tanzania, oil and gas. And the governments will be looking to, first of all, strengthen and implement new policies that will benefit the countries independently. Going forward, obviously, we'll have to look at the East African community in general and see how we can be able to increase our synergy. But as it stands now, all the countries are focused primarily on their own independent economic needs, other than that of the whole community. So regionally, it's very hard for all of us to come together and work together on oil distribution.
Well, one of the firms that has managed to leverage off the East African community has been Nation Media Group. We've seen the company, amongst others, increasing its turnover and profit, aided in part by the strong business performance in maturing East Africa bloc, outside of South Sudan specifically. What's your sense of Nation Media Group right now? Because yesterday, that share price rising a further close on 3% by the close of the session, and that after posting a 25% rise in full year profit last week.
We've seen demand surge up after they announced a 10 shillings per share dividend and the 1-for-5 bonus. Basically, from the results, what we read most is the strength in profitability from subsidiaries outside Kenya. That is mostly Tanzania and Rwanda. Nation Media are involved in print media, digital media, TV, and radio. So they spent most of the year introducing new brands into the market. And so their focus going forward is to consolidate and to beef up those operations. However, what was perhaps disappointing in some way was the ad revenues that they got. We were expecting them to increase their ad revenues because on the back of heavy electioneering and perhaps end-year business cycles, but their ad revenues grew very thinly. So going forward, we are looking at cost efficiency and cost containment in their business.